guys, we're back with another episode. We're going to do MFX ChartKings episode 3. Today we're going to be going over something basic, but that's really important, which is support and resistance. So pretty much what we're going to be going over is, like I said, support and resistance, but I don't want to just call it that. I want to call it something called, let me write it down for you. Give me a second. It's called PRZ, which also stands for Price Reversal Zone. So now what a price reversal zone is something, is simply an area on the chart or a certain price on the chart that every single time the value of a currency pair ends up going up to this number, the market will reverse to the downside. So if you have a look at the red zone, we can see every single time that the market came up, it reacted very harshly. If we start off with these wicks, the market came up to the red area, reacted harshly, did the exact same thing again, could not break above this area. Can you see no candlesticks are formed? Every single time the candlesticks close, it's below the red area. Now, if we did come over again, we can see rejection. Now, just look at this candlestick. You can't really get any more of a rejection than this. You can see the market did not want to be up there. That huge wick showed you that the market went all the way above the red area, but by the time the day closed and this candlestick finished at 10 p.m., we were all the way back below, making us know for certain that this is resistance. You can see here, this is a fake out where the market broke out, pretended that it was going to go up, but in fact it continued to go down. This one as well, this is pretty much just a gap, but I'm guessing that at least when it opened here, the candlestick close was below the red zone. Another fake out. We come over here, rejection. You guys get the idea. When you see loads of wicks in an area and the market cannot get past that point, that is a price reversal zone. Now, what's interesting is that they can happen from the downside going up and reversing, from the downside going up and coming back to the downside, but they can also reverse, because it doesn't matter what side it's coming from, it's just a price reversal zone. So you can see when this green area starts getting attacked, the markets came down, sellers, but then the buyers started coming in very harshly with these huge wicks, and then you can see we shot back up to the upside. Scroll across again, the market came down, just tapped the green area literally to the wick, and then shot right back up, did not want to be near that area ever again. And then we went up, was out, we didn't touch the green area for quite a while, a couple months, but then when we started coming back down, what's interesting is that if you look at the candlesticks that start to approach, you can see that they're very bearish in nature. Like you can see, this one has no wick on the bottom, meaning that it's literally sellers coming in very aggressively. Then when we came down again, they came down with so much force that they were able to break this green zone. Now, when that happens, when you get a break of a price reversal zone, what you can expect to see is the market to come back up and give it one last test before it will continue to go down to the downside, as it clearly does here. This is what a price reversal zone is. They will break, support or resistance will break, and it will come back up for a retest, and then this is the best area for you to get in as a sell. Now, there are a few more techniques that we do use to pretty much find the perfect entry and ensure that some of the retests aren't fake outs and things like that. It's all taught in the course, but the basic concept is that, like, when you break a price reversal zone, you're going to come back down. You're going to break it, then retest it, and then shoot back down, and it's the exact same thing on the way up. I mean, I could just go to a random point in the chart right now, just before we finish, just to prove it to you, or just give you another example. Yeah, bang on right here again. So you can see, I can see, because I'm on the chart so often, my eyes are attuned to these kind of things. It's called training something called a reticular activation system. We talk about it a lot in the course, but that's why I'm able to pick up on it. It's just chart time. But if you have a look here, we can see we're having a lot of rejection with these wicks right here, meaning that every single time the market comes into this area, what's happening is that it doesn't want to be in this area at all. You can see it's very rare that the price doesn't spend much time in this area. That's the best way I can put it. It doesn't like to be there whatsoever. It will react harshly off it. I mean, just look at the first touch. Everyone in the course knows that this is a certain reversal pattern, and it's extremely bearish in nature. Just the fact that it has a huge wick to the upside, but then it comes back down and has no wick to the downside. That's a certain pattern that we like to see, because it means that the market really did not want to be here. And by the time the day ended, the sellers were just continuing on their way. Like from when they started dropping, they didn't stop dropping until the day ended. So that's extremely bearish. Wicks, 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 wicks. You can see rejection, rejection. But then look, when the market broke above, what did it do straight away? Use that area to act as support now from the other direction with a huge wick to the downside, letting you know that it couldn't hack it. Started going back up. Then we have this candlestick, something similar to like what we saw last time. A huge rejection, didn't want to be in the green area, and then the market continued to shoot up. And then you can see when the market dropped again, touched this area and shot up again. So this is what a price reversal zone is. Hopefully this is deepened your knowledge on support and resistance, and you can understand how they apply and how it's not just ones on the top, ones on the bottom. It's just an area or a price that the market doesn't want to be at, and every single time it gets near there, based on what it's done previously in the past, you can predict what it's going to do in the future, letting you know whether you should buy it or sell it. So hopefully this helps. This is lesson 3. And yeah, man, hopefully you guys can apply this, and I'll see you in episode 4 of Chart Kings, and I'll speak to you soon. See ya.